Now, here is Ticky Fullerton on Your Money.
Hello there, I'm Ticky Fullerton, every night bringing you a full hour of the very best in business coverage across the nation and internationally, especially where business and politics meet. Coming up, new Bendigo and Adelaide Bank CEO Marnie Baker, direct from the AGM, tackles the lack of trust in the financial sector and the bank's experience with the Hay and Wrong Commission.
Good morning, everyone.
The CEO's interview with Your Money chief business reporter Leo Shanahan coming up. Caltex shares slide despite good news on its dividend policy, talking surging fuel prices and selling the Caltex business strategy with CEO Julian Segal. And industry super versus retail super. A new Productivity Commission report complains of a retail fund fee gouging, but Chant West says industry funds aren't all they're cracked up to be, unpacking the issues with ASFA CEO Martin Fay. Now, we know that government intervention is everywhere. Could petrol prices, an intervention or a capping of petrol prices be next? Well, I went down today to a blustery Kurnell, to Caltex's huge fuel import terminal to catch up with the big boss, Julian Segal. He was out there with a record number of investors for his big strategy day. As usual, the market was having great difficulty understanding the business. On the surface, high oil prices have fed into high petrol prices and low sales at the Bowser. And there was an unplanned shutdown at Caltex's refinery at Lytton in Queensland. Caltex's outlook saw shares fall to their lowest in 4 years, down 1.7% before coming back to just under 1%. But then there's the government. Julian Segal has successfully restructured Caltex into two parts: fuels and infrastructure on the one hand, and the retail, petrol and convenience stores on the other. Well, both these businesses could well be under attack by government intervention. First, those pesky petrol prices, which we hear might go to $2 a litre. God, there's something about that. But what? A cap? Now, the problem for the government is that this is not like retail electricity. There, in retail electricity, government might be able to point out some mischief and price gouging. But the petrol refining and distribution business is a much simpler margin business. Crude oil goes up, and that's going to affect the price at the Bowser. Now, we can all argue about fuel companies being quick to raise prices at the Bowser and slower to lower prices at the Bowser. And of course, Rod Sims at the ACCC is on the warpath about any cartel behaviour. But as Caltex CEO Julian Segal pointed out to me today, it's the government, not Caltex, that actually takes the lion's share of net profit from the Bowser. About 40% of it in fuel tax. So in a 50-litre tank, and these are based on ACCC figures, and the average price of petrol in New South Wales at, say, $1.56 a litre at the moment, that would cost the consumer about $78. Well, guess what? $31 of that goes straight to Scott Morrison and Josh Frydenberg government pockets. The retailer, like Caltex, only gets about $12 of that $78. No wonder the Prime Minister is today under pressure to drop fuel taxes. Our interview with Julian Segal coming up. Well, let's go to banking first of all. Bendigo and Adelaide Bank CEO Marnie Baker, she's just hot in the new job, says more Australians than ever are questioning their choice of banks. Speaking at the company's AGM, Ms Baker says Bendigo and Adelaide banks are strong and innovative and understand what it means to represent community expectations.
More so than ever, Australians are questioning their choice of banks. And more than ever, Australia needs a bank like ours. A strong and innovative bank that looks after the interests of its customers and understands what it means to represent community expectations. A bank that feeds into the prosperity of our customers and communities, not off them.
Well, Ms Baker's comments come after the release of the inaugural Deloitte Trust Index for Banking, which has solidified the sector's diminished standing in the eyes of the general public following the Royal Commission. Well, for more on that AGM, let's bring in Your Money's chief business reporter, Leo Shanahan. Leo, hello. That trust index, first of all, that's come out, I mean, we were to expect something like that, weren't we?
Yes, well, of course, we had that polling with Michael O'Shanahan the other week showing just how much the major banks have fallen in the eyes of their customers and the public more generally. And of course, it doesn't surprise me that you're going to see the major banks now as some of the most distrusted brands. Bendigo and Adelaide claiming not only are they more trusted, but one of the most trusted brands in Australia, giving that kind of community rural vibe.
So we've had also the bank CEOs before Parliament, before one of those committees the other day. They sort of paned their way through that. They've got to go back to the Royal Commission, presumably for even more of a grilling. But of course their results are this week and next week. What are we to expect? Well,
it will be very interesting to see, I think, firstly, NAB's extent of write-downs on the back of, you know, regulatory fees, fines, refunds, all the provisions. Now, NAB, unlike ANZ and Westpac, haven't actually itemised those yet prior to the AGM. So it'll be interesting to see what they say at the AGM.
Well, haven't they got a big possible liability with ASIC?
Yes. Well, this is the point. I mean, they are now trying to work out how much they could be liable for under this action brought by ASIC. And ANZ have released figures a couple of weeks ago. It was about 300 million, I think, from memory. So, look, all of them, these provisions are biting now, and it's all very well to say, oh, it's a drop in the bucket, but this adds up. And for the big banks, these provisions are adding up and are beginning to hurt in an environment where margins are being squeezed and cost cutting is taking place. And the overall size of the banks are coming down because they're selling off businesses. Exactly, cutting up large chunks. So we're going to speak to, I think, the CEOs of both NAB and ANZ later this week. You have interviewed the new CEO of Bendigo and Adelaide. Tell us a bit about her and the bank. Yeah, well, obviously she's been in the role for about 3 months now. Bendigo, the 5th largest retail bank in the country, so she's arguably the most powerful woman in Australian banking, although I think Macquarie's head probably tipped over the head. But look, I think it's interesting given she hasn't been in the role too long, but she got started with this new digital bank that has been established, wholly digital bank being established by Bendigo and Adelaide, as well as a mortgage product to accompany that, which is interesting. And this is what I asked her, given Bendigo and Adelaide's focus on the customer, and one of the big selling points is they still have branches. You can still go in and talk to people, and interesting is that it alienates any of that customer base. They, of course, have also been forced to move on interest rates earlier than others because of the funding pressures, so I asked her a bit about that. And of course, what the Royal Commission said about them. It's all very well to say we're quite trusted, but they certainly didn't get off scot-free in the Royal Commission. And I asked her what they're doing to remediate customers. OK, but really, the worm has turned, if you think of sleepy old Bendigo and Adelaide Bank at the heady days when the big four were real pillars. But really, the worm has turned in that having that sort of genuine customer focus, or what appears to be a genuine customer focus, has very much played to their favour. Yeah, and in a regulatory sense, in a policy sense, it's only going one way. It's only going towards them. I mean, take a look at the bank levy, for instance. It wasn't put on the smaller banks, the community banks. You've got a regulatory environment which is really going after the bigger banks and bigger financial services firms like AMP. All right, well, let's go to that interview of yours. Your Money Chief Business Reporter Leo Shanahan spoke with new Bendigo Bank CEO Marnie Baker a little earlier. Marnie Baker, thanks so much for joining us.
Pleasure.
Now, you said today the Royal Commission has cast a shadow over the industry. You said trust is at an all-time low. What has Bendigo and Adelaide Bank failed to do for its customers to erode that trust?
I was specifically referring to it at an industry level, and you'll see the research that's coming out, and I think Deloitte's have just recently, over the last couple of days, have launched a report around trust, showing exactly the same thing from an industry perspective, that it actually is at an all-time low. I did, however, contrast that with our own business and the fact that independent research from Roy Morgan has actually shown that we are the most trusted bank in Australia. Not only that, we're in the top 10 most trusted brands in Australia, which is across all industries, not just banking. And in that same survey from Roy Morgan has the 4 major banks in the bottom 10 of the most untrusted banks in Australia.
That's true. Bendigo hasn't gotten off scot-free from the Royal Commission, however. There's in Royal Commission documents, 1 episode of fraud, charged fees for no service, charged incorrect fees on overdraft and underpaid customer deposits. What is Bendigo doing to rectify these issues?
Well, many of those issues that you've actually raised are things that we identified ourselves and actually have been rectified. So you are pulling up past things, and the Royal Commission did do that. It delved back quite some time. We're not immune also to making mistakes ourselves, and we own up to those mistakes when we do, and we do become aware of those. I think it's how you actually, what you do once you realise or it's been brought to your attention that a mistake has been made. And we'll always look to rectify those in a timely manner that puts the customers back in the same position that they were in prior to that mistake being made. So they're not disadvantaged for a mistake that we've made as an organisation. So, for example, I think you referred there to fee for no service. We made some disclosures in our full year announcement that there was about $2.5 million that we're working through payments to go back to some of our customers. We've made took a very conservative view in relation to that. This is in relation to annual reviews for our clients, financial planning clients, where we could not see that there had been properly documented reviews undertaken. We took the conservative view, even if we were told that that review had been undertaken because it hadn't clearly been documented, that we would be actually refunding those fees. So those are things that we've been working with the regulators on. But the commitment that I do make is not that we won't make mistakes, but when we do make mistakes, that we will actually rectify those in a timely manner.
You mentioned a lot of these incidents took place in the past. A lot of them involve Rural Bank, actually. Is Rural Bank a regulatory liability for Bendigo and Adelaide?
No, not at all. Not at all. Rural Bank actually did, and the Managing Director from Rural Bank was up in the witness stand as part of the Royal Commission earlier on. And there was some issues. There was some issues in relation to some loans within Rural Bank. This is from 10 years ago, so a decade ago. The bank itself actually identified and was concerned that we actually hadn't done the things that we should have done at that point in time. We instigated reports and independent reports to be undertaken on that so that we could get underneath that and understand any issues that we may have. And following on from those reports, we remediated the situation and made changes to policies and so forth to ensure that those things weren't going to happen going forward.
Yes, as you mentioned, the bank has certainly come off a lot better than the 4 major banks from the Royal Commission. Has this shown up at all in, I suppose, more business for the bank, or what has the customer reaction been generally?
Yes, it has. I mean, we're seeing more so than ever people starting to choose to move their banking to organisations that they believe more align with their own values. So once where we saw that consumers are very apathetic about their banks, we're now starting to see them actually vote with their feet. If they're not happy with the behaviours that they're seeing within their own banking provider, actually making that choice to move to someone that they are more comfortable with, that will behave in a manner, like I said, that more aligns with their own set of values.
It was interesting at the AGM this morning, one of your shareholders made the point that perhaps the drought is a greater threat to the bank than the Royal Commission. How is the bank handling the drought, especially the Rural Bank and the community banks?
Yeah, and I think the chairman said at the time too that we've been around for 160 years, the community bank model 20 years. So we've been through periods of drought with our customers and communities over that period of time. So not to diminish the seriousness of the current drought that parts of Australia are in, we have been here before, and who we are as an organisation is around actually working with our customers and those communities to ensure that they can actually get through these periods of, of tougher times for them. We have all of the things like you would expect to find in a bank around hardship policies to ensure that people can access those if it does get to that situation. But what we try and do is early, when we see some of these indicators coming through, start working with our customers and communities at that point, so it doesn't get to a point where they are in desperate trouble.
Yeah. Now, interest rates are on the rise. The major banks have followed suit, lifting their rates in recent months. You were one of the first, blaming increased funding costs. Can we expect more rate rises by Bendigo and Adelaide soon?
Well, that depends on what happens with things like funding costs. So we're assessing our pricing all the time, our interest rates all the time, making sure that it's appropriate given stakeholders, and you've got to recognise that it's both about depositors and borrowers, and I know that everyone sort of tends to focus on the borrowers, but remember, rates themselves are at record low levels, so if you think about the retirees and depositors who aren't getting too much return on their funds at the moment, we've got to balance those two things when we make any decisions.
Now, accompanying that, we've seen a drop in the property markets. How exposed is Bendigo and Adelaide to increased property price drops in major cities, but also in regional areas?
Yeah, so I mean, we're from an industry perspective, we're seeing some of those drops is, in parts of Melbourne, parts of Sydney. We don't have a large presence in the parts of Sydney that are starting to see some of that decline, and you've got to recognise that the decline is relatively small in comparison to how we've actually seen those property prices actually rise over the last few years. So it perhaps is just the start of a cycle, and it probably will move into the next year. But our exposure into some of those areas isn't probably the same as what you might find with other financial institutions, and I'm more referring to the major banks. Look, in relation to regional and rural areas, again, some of those, we're seeing some areas that property prices are actually increasing. But again, and it's not necessarily, it's usually not as volatile in regional and rural areas as what you'll find in the metropolitan areas when you do start to see these changes in the prices of property.
The chairman made the point today as well that the Productivity Commission had released a report into competitiveness in the financial services sector. What are your top priorities for reform in this area? Capital funding levels up there, they must be?
Yeah, absolutely. And, if there's one message to take from the Productivity Commission, and also what the Commissioner has actually written in his interim report, is that the competition is lacking. We do have the right number, I think, of incumbent financial institutions in Australia, but unfortunately there are things from a regulatory perspective, I can speak to that, in relation to capital and funding and so forth, that does actually put those outside of the majors at a disadvantage to be able to compete on a level playing field. They're things that as an industry, the smaller banks, the regional banks, and outside of that, the credit unions and so forth are lobbying to actually get change so that we can compete and let customers or consumers make their choices accordingly.
And just quickly on your new digital bank Up and your mortgage provider TikTok, these are pretty interesting movements for a bank that prides itself, I suppose, on that customer care line. Do you risk perhaps alienating, especially older customers who value that person-to-person contact?
I don't think they're mutually exclusive. I think there's a place for the digital and technology, and for those that want to self-serve and do things online. There's also absolutely a place for the face-to-face, over the phone, in a physical branch sense interactions with customers. And we're seeing consumers having preferences for both of those, not just necessarily one. So when it comes to transactions, you'll find that most people would actually prefer to be able to do their transactions at a time that suits them, and they don't need any assistance to be able to do that. So the online functionality actually works well. Once you get to some more complex transactions or advice or things that appear the first time someone's looking to actually take out perhaps a home loan, don't know what they're really doing, they want to be able to actually sit down. Or when people get into some financial difficulty, they actually want to speak to someone in person, and a chatbot really actually doesn't cut it at that point in time.
After the break, 3 of the big 4 set to release full-year results over the next few days in banking. We'll find out what to expect with Adam Dawes from Shaw & Partners next.
You're watching Ticky on Your Money. Now, back to Ticky.
Yes, welcome back. The bank's in focus this week with full-year results out tomorrow for ANZ, NAB on Thursday and Westpac next Monday. We'll be talking to ANZ and NAB chiefs this week. Macquarie Group also reporting its first half results for Friday. I'll be waiting in anticipation to see how the results will be impacted by recent negative consumer sentiment and the many millions in customer refunds and compensation that we've seen come out of the Hayne Royal Commission. For more on what to expect, Adam Dawes joins me now from Shaw & Partners. Adam, the market is really looking at this, isn't it? Looking at what the banks are going to be able to reveal.
Yeah, and it's going to be those headline numbers, but then it's also the 90 pages, and it's going to be what's in those back, 5, 10 pages that are going to be what the market is going to be really looking for. Net interest margin certainly going to be something that we need to look at. Loan growth, how's that actually going? And bad and doubtful debts and how that's going to happen.
Okay, so going through them, your net interest margins, those NIMs, they're under pressure?
Very much so, and I think they're going to narrow. So
right, for all of them?
For most of them, yeah. I think so. NAB will probably be a little bit more. Sorry, a little bit less due to the fact they've got sort of small to medium enterprises businesses. Yes. But
well, the others are very exposed to housing.
Absolutely. Very exposed.
Meanwhile, they've got the wholesale funding offshore and the rates going up in the US.
Exactly. Bad debts. We're going to see that. Perhaps with this housing market cooling off, we might see that bad debts, but I don't think that's going to be the issue. I think loan growth is going to be the biggest thing. Banks are going to have to show us investors how they're going to grow their book or where the earnings are going to come from.
Because after all, they're going back to basics. This is their business.
Shrinking to greatness.
Shrinking to greatness?
Yeah.
Yeah. Simpler, better banking?
All because of the Royal Commission. So really then, what is going to be the count on that Royal Commission and what are the costs?
Well, that was the other thing I was going to ask you about, because the Royal Commission has really hit them for 6 on the provisioning front.
Absolutely.
And it's unclear as to whether the provisioning that's out in the market is all the provisioning that is required.
That's right. So all the costs, lawyers, for them to turn up to the Royal Commission, for the lawyer, for everything. Yeah. We think of CBA was about $2 billion. We think, and now
and making it right with consumers, presumably.
That's going to absolutely. So, Westpac NAB about $1 billion. Yeah. Putting that into context, that's what, 2 months worth of profit. So, still. It will count. Even
though they've shrunk, but it's actually going to be more comparatively than it would have been, say, 2 years ago.
Oh, absolutely. Absolutely. And more headline driven as well. So people are going to focus on that, and I think that's going to be a real issue for the banks.
Yeah, and I was saying to Leo, NAB still hasn't been not really clear on what their issue is with ASIC and how much. I mean, that could be quite a big number.
Very much so.
We've had big numbers from the other banks.
Yeah. Well, NAB today didn't rally as much as the rest of the banks. We saw all the other banks up, 1% or so. NAB was in the green, but wasn't as much. I think that's got a lot to do with the dividend, and we don't know if that dividend is going to be maintained as well. So that's going to be a tough for NAB. Macquarie Bank's
first results as well under Shamara Wickramanayake. Yes. I can say that now.
I'm glad you did.
And so we're expecting something good
I think so. You know, if you were going to ask me which bank I would buy, it would be Macquarie. Yes, it's not one of the big fours, but certainly these guys have got 20% of their book is mortgages or loan growth, or very much focused here in Australia. Yeah. The rest of it, all assets, they're deal makers. They'll do very, very well. The global economy, yes, we've seen a little bit of a speed bump over the last month or so.
Any issue in Germany at all for them?
I haven't seen anything in there.
Okay.
You think that there's going to be...
Just some of the reporting about some issues around, you know, in Germany, but not broadly. I don't think. Yeah.
No, I think we're going to do very well. So
okay. Now, the other issue, of course, is Healthscope tomorrow.
Yeah.
Now, we're going to hear. We haven't heard anything about due diligence being granted to private equity.
Yeah. Look, they're going to have to come in, and they're going to have to. Well, with this second bid now, I think they're really going to have to at least open the room up so that they can have a look inside there. And I think shareholders want a result as well. You know, and that's been plaguing the stock. They said no to the first one, the stock fell. Now this next one's coming through. A little bit of selling pressure coming in, but obviously it's been now hamstrung by this takeover. And really they need, and I think shareholders want a result one way or another.
And Adam, more broadly, the market, we had that sort of technical correction, didn't we? How do we feel? Are we sort of bouncing around, or are we going to go?
Today was a great day, so I was really, absolutely very, very happy. Is this the trend or the V-shaped recovery that we're looking for? I hope so. I certainly think that there is still some more issues.
Just a slalom bump as we go down.
Well, that's by the dips at the moment. I think that's what it is. Everyone's looking at Trump, G20, China.
Yes.
That's going to be the big thing, and that's why I think our market rallied today around lunchtime. There was some talk about them coming together for that G20 summit to perhaps put a deal together. If a deal does come, that puts certainty under our market, and our market will put our buying boots back on.
Awesome. Let's hope that happens. Adam Dawes, thank you so much for joining us.
You're welcome.
Okay. After the break, rising fuel prices adding to the complexity of the Caltex business. Why my one-on-one interview with CEO Julian Segal coming up next.
This is Ticky on Your Money, covering the big business stories.
Yes, welcome back. Well, Caltex is upping its dividend payout ratio to the equivalent of between 50 and 70% of earnings from 40 to 60% previously. On the other hand, a drop in the Aussie dollar and the crude oil price has been positive for the has not been positive for the company's refiner margin, particularly as the year ended. The company's third quarter unlagged Caltex refiner margin came in at $12.17 US a barrel, up from the previous quarter, but a drop from the prior corresponding period. For more background on those results, I spoke with CEO Julian Segal a little earlier. Julian Segal, great to catch you out here at Kurnell.
Thank you very much for coming all the way to Kurnell.
Well, just looking at your share price now, I think it's coming back as we speak, at sort of 1.3% now, but it touched 4-year lows. I mean, that's a little bit about the market just trying to get to grips with the company, isn't it?
Well, what a great opportunity. We have about 50 to 60 people, shareholders and analysts.
Next door, is that a record?
It is a record.
Now, what do you think that says?
I think it says that people want to understand the Caltex story better. I think there's a lot for us to explain. We'll be taking actually 2 days to do that. First day, fuel and infrastructure, which I think is a story that people really don't understand well, because for the last few years we focused so much on the retail story that we've forgotten to tell the fuel and infrastructure story, and then tomorrow we'll be focusing on retail.
Right, well, let me come to the retail side first. And I guess you're in quite a challenging time in the cycle at the moment. Can you explain why?
Yes, I can. And the reason is that crude prices have gone up significantly. Only a few months ago it was about $40 a barrel. It's over 80 at the moment. And at the same time, the Australian dollar has gone down. And that really put a lot of pressure on pricing. The customer sees much higher prices at the bowser. It happened before. We have experience with that, and the initial reaction is to buy less.
So the volumes are down significantly?
The volumes are down, and the margins under pressure as well. So we've been through that. We've been through that cycle before. In fact, we have seen over the last couple of months a reversal in trend where the things are getting a bit better.
So there's been a lot of talk at grassroots level about prices at the Bowser, possibly even $2 a litre at the Bowser. Can you see that happening?
Look, I really cannot predict. If you recall, a few years ago, crude prices hit $160 a barrel. I hope it's not going to go that way. The reality is whatever comes up will go down. So yes, the prices are high at the moment. You can rest assured it will go down. When? I can't tell you.
Julian, are you worried, though, in this climate of government intervention? Now, we're in an election campaign right now, that there might be some sort of intervention here? And the Prime Minister has asked Rod Sims to review petrol prices. Rod Sims himself is looking at all sorts of issues, including the possibility of cartels. Can you see the government actually intervening and possibly even capping prices?
Well, you can always nationalise the industry altogether.
Yes.
So there are possibilities. I hope that's not going to happen. I'm really being a bit facetious here.
But if they capped retail prices, obviously that would have a big impact on the business by definition.
Well, if you cap retail prices and the crude prices going up, it's not sustainable.
No.
It's just simply not sustainable. And so I think there's a very big difference if you compare, for example, the electricity market situation with the petrol market situation. In the one that I'm operating in, which is the fuel market, you've got basically two forces, external forces, over which the government hasn't got any control. We don't have any control. The crude price and the Australian dollar rate of exchange.
The other side of your retail business, of course, which you put a lot of time and energy into in past months, is your food and your consumer side. Now, in August, you announced a deal on the property side. It wasn't quite as far, perhaps, as some in the market had wanted in terms of a property spin-off. How is that all travelling?
So the property question, what we call the asset optimization question, was not in any shape or form about selling our assets.
That was a sale and leaseback, wasn't it?
The whole idea behind this strategy is how can we deploy our sites, our real estate, in the retail sector in a strategic fashion. It was not about us actually releasing money, because that's not going to happen in any shape or form. The moment we sell and lease back, it doesn't create any headroom in our balance sheet.
Right.
So it was really about, can we deploy our sites that we own in a strategic manner? And what do we mean by that? Can we develop a whole site, not just foodery or petrol and convenience site, but can we have additional offering to our customers? Therefore, bringing more customer to the site and therefore enhancing the value of the site itself.
Are those sites in the future going to be just as useful when we eventually get to electric vehicles?
That's a very good point, Ticky, and that's why we embarked on this strategy 2 years ago. We can see that in the future, and it's not going to happen tomorrow, you are talking about 10, 20 years' time, then clearly what we would be achieving by then is a shift between the balance of fuel to convenience. Today it's probably 70% fuel, 30% convenience. What we're achieving with the foodery concept, and now obviously with the rolling out of the metro concept, is shifting the balance from 30-70 to 40-60, 50-50 and so on. So by the time that EVs, for example, will make an impact, we're going to have a very solid convenience offering, not relying on fuel alone.
Well, let's go to your fuels and infrastructure side, which is actually the bigger chunk of the business under Louise Warner. Here we are at Kurnell, which was a refinery. You've converted it to an import terminal. How is the international side of your business going now? Because you put a lot of emphasis on the growth that is going to happen from this side of the business.
You're absolutely right. But I just want to remind you that the reason we can grow is because we've got now a very solid, well-performing business. And that's happened over a five-year period of time. Now that we've got this absolutely strong business, we can grow the business. And in fact, you may recall at the half-year results, we said that international volumes grew by 87%, and we sold about 1.8 billion litres. That's very significant. We believe there is significant scope to grow that volume further, based on our capabilities, our terminal infrastructure, our ample Singapore capability, our
your
shipping
trading hub up there.
Yeah.
Okay. Well, now let's talk about Lytton. It's your one refinery there up in Queensland. Caltex refiner margin, I think, had a bit of focus from the market earlier today. Now, that actually is down on this time last year. And when I think about the Caltex refiner margin, shouldn't it be going, I think of it going up when crude oil prices are going up. So what are the other factors that are involved here?
I think the important thing about refining margin is the market sees refining margin as a very volatile component of our business, and that's true, but they need to remember that the volatility is at the upper end. And yes, you may well say last year the refining margins were better, but it was an upside. The reality is, if you look over the long term, there is pretty much a platform, an underpinning platform below which the refining margin don't go. And so, yes, there is some upsides from time to time, but in fact there isn't huge periods of time where you do have a serious downside.
Yeah, so in other words, the Lytton refinery is now in a level of efficiency that it is profitable and will continue to operate. So
what we need to remember that in fact Lytton refinery is generating a lot of cash, even in periods when the refining margins are not that high. And when they are higher than normal, because today we are normal, when they are higher than normal it's just a bonus.
Yeah, I should just mention that in October this month you had an unplanned outage at Lytton as well. So that's going to hit EBIT, what, 15 to 20 million, you say?
It was an issue to have the reformer at the refinery. It's obviously not a welcome incident. However, I have to say that there is no refinery, old or new, that will not have an incident from time to time. And so overall, if we look at the performance of Lytton over the last 5 years, it's been exceptional.
Yeah, and you're not expecting anything else?
No.
Now, the other area of possible intervention that's being talked about, of course, is on the fuel security side, national security, that the government has been talking about, the idea that maybe we've only got 20 days worth of petrol in the country and only, 59 days of LPG. Now, I know Josh Frydenberg has a review coming down, I think, at Christmas on all of this. I mean, can you see an Australia where we actually end up opening a refinery?
I think the refinery question is pretty clear in my mind. That's not going to make any difference because you can import crude to be processed by the refineries, or you can import product, finished product. In both cases, you've got exactly the same national security risk.
Now, they for some reason don't see it like that. You know, if you've got the refineries here that somehow...
See the submarine, the enemy submarines waiting with a gun, with a rocket to say, this is a crude ship, we'll let it go, this is a diesel ship, we'll stop it. So that doesn't make any sense. I can understand the argument towards having reserves of finished product or crude in Australia. But in my mind, and I'm not an expert, I have to say, in my mind we've got extremely reliable supply chain infrastructure put in place that actually has proven itself year after year, decade after decade. So the evidence doesn't point out that we've got a problem.
And so your outlook for 2018, I guess a short-term hit from Lytton, and I guess the high oil prices and the volumes on your retail side. Is that right?
Yeah, that's correct. And as I mentioned to you, the third quarter was particularly hit in terms of the crude prices going up.
I mean, they're coming off again now, so is that likely to play into anything?
That will be a benefit. And look, I sympathize with the consumer.
Okay.
I absolutely sympathize with the consumer. All that I'm saying is the prices have gone up. It's not within our control. It's not within the government control. They'll come down again.
I should also mention capital allocation and your change to dividend policy, which is good news for investors. Does that reflect, some satisfaction with the turnaround that you've managed to achieve?
It does. So if you look at Caltex, we're a large company with very predictable cash flows, both from our fuel and infrastructure business, and that's growing, as well as a very predictable and stable retail business. And on that basis, we're confident that we can do that. We can change the policy from 40 to 60, to 50 to 70.
And any acquisitions in the pipeline, do you think?
There's nothing I can comment on. Clearly, we've got the target to invest our money in the opportunity that will return best value to the shareholders. we made it very clear that in the absence of better opportunities, we would return the money to the shareholders.
Well, in a buyback, as you did in 2016.
That will be our preferred way.
Okay, all right. And 2019?
Well, 2019 is going to be better than 2018 as we keep on rolling out our F&I strategy, as we expand internationally, and as we improve our operation in retail.
Julian Segal, great to talk to you on the ground here. Thanks very much.
Thank you so much.
Right, from the east and the coast of Cornell all the way through to Western Sydney, which has emerged as a food and grocery manufacturing powerhouse, generating $17 billion in output per year and employing about 24,400 workers, according to new research released today by the Australian Food and Grocery Council. However, the report shows the industry output for 2017 did fall by 2.5% for the year. So why the slump? Well, the Australian Food and Grocery Council CEO, Tanya Barden, is here to unpack the groceries. Tanya, great to have you here.
Thanks very much,
West. Now, tell me first, because obviously we know what an important sector this is, but why the slump? Why are we going slightly backwards?
So look, food and grocery manufacturing has been a very resilient sector nationally. So the trend we're seeing in Western Sydney really reflects that. So
and what is food and grocery? Let's remind everybody.
So food and grocery manufacturing is everything people buy in their supermarkets, the essentials of life, whether it's food, whether it's personal care, cleaning products, from your nappies, your ice creams, your soft drinks, your meat, your chips, your healthy cereals, all sorts of products.
Okay, so, and it's had this little lilt. Why?
So it's a sector that is under pressure from cost rises. So we've had in recent years impact of energy prices rising significantly. We've seen impacts coming through in labour, transportation, more recently the impact on input costs from the devaluation of the dollar. And these cost pressures have come at a time when we've also seen 7 years of retail price deflation in the sector.
So, and you mentioned labour there, even though we're not really seeing much wages growth.
Not seeing much wages growth as a nation, but our sector generally is an above award payer, so good, strong, stable jobs, but also well-paid jobs as well. Okay, so just how big is the sort of food and grocery business within Western Sydney, and why has that taken off? I mean, because on a national basis, it is very much a centre, isn't it? That's right. So nationally, the sector turns over $127.4 billion and employs 320,000 people, and 40% of those are in regional and rural communities. And in Western Sydney alone, as you mentioned, we're turning over $17 billion and employing 24,400 people. So Western Sydney is a great spot because, you know, obviously you've got the amazing distribution networks that you've got out in that area now with, you know, some good urban transport infrastructure. We've got a lot of the retailers housed there with their distribution centres. So being close to be able to distribute product is important, particularly to such a massive urban population that you've got here in Sydney.
Yeah, so what's the next step? I mean, we're talking about population ever increasing, notwithstanding what the Premier would like, but also a possible third city, which is going to go ahead in the west. Is that going to, I mean, are you very conscious of the fact the opportunities for growth there within industry too? That's
right, opportunities for growth for demand, but also the availability of skills. So Western Sydney does have a large population base. That's going to grow by another 1 million people over the next 20 years.
It's going to have an airport?
It's going to have an airport, so that's great opportunity for export. But as an employer as well, we've seen that in Western Sydney, our employment growth has been 5.1%, which is compared to only 3.5% for Western Sydney employment more broadly. So you want people in Western Sydney to be able to have local jobs so that they're not having to put pressure on public transport, on infrastructure to get all east into the city.
So one of the great things about Western Sydney is that there is this great food basket out there, which presumably feeds into your manufacturing.
That's right, that's right. And in fact, when we talk about the direct impact that this sector has, that 320,000 jobs, that doesn't include the amazing impact that we have through supply chains. So we transform a third of Australia's agricultural product domestically, gets transformed through our manufacturers. And so being able to bring some of that into a hub like Western Sydney, transport it then out through somewhere like Badgerys Creek into export opportunities is a great growth potential. Is
the expansion to create a third city going to eat that absolutely wonderfully fertile food bowl out there in the west? I mean, we're going to find ourselves cannibalising ourselves?
Look, there's always going to be pressure on land from urban developments. You know, we're fortunate that this country does have a lot of great farmland. You know, there's a lot further down in New South Wales into Victorian areas.
But this is really special, sort of, you know, for market gardening type stuff as well. It's a bit like south of Melbourne, isn't it?
That's right. There's always going to be those challenges of urban and farming, you know, living side by side, but they're both things that are essential to our economies and communities, so making that work is really vital.
So do you think think that next year you'll be back up again, or do you think that these ongoing challenges are going to curb growth of the sector?
Look, we are concerned that these cost pressures are really placing some significant burden on industry at the moment. We are also concerned about the fact that capital investment has declined and is really still below the levels of the GFC. So again, it comes back to that competitiveness, viability of manufacturing in the face of some of these domestic pressures. So we're really interested in what we can do to try and stimulate investment and maintain that presence in Australia so that we can take advantage of some of these export opportunities. You know, we talk about the clean, green, the great food safety record we've got in China. We want to be able to harness that and become more of a growth
briefly, any worries about the sort of instability around government at the moment and policies everywhere up in the air?
Look, stable government's always important for industry, and so we just encourage more of that, particularly around energy.
Tanya Barden, very nice to talk to you. Thank you very much.
Thanks very much, Ticky.
After the break, talking industry versus retail super funds with ASFA CEO Martin Fay.
Now, back to Ticky.
Yes, welcome back. Well, turning to the battle now between retail and industry funds, the fox and the farmer over the henhouse and our savings, if you like, according to the advert that's been run earlier this year. Now, it's been a big couple of days for the superannuation industry. We had a Productivity Commission release, which released a fresh report on Friday, revealing excessive fee gouging going on in the retail sector. Now then, we were also told that reports that opposition leader Bill Shorten may come under pressure to ban retail super altogether. And then research house Chant West on the weekend released some comments saying, no, industry funds only perform better because they load up on risk. All the while, Australian super fund managers deal with the market correction that wiped out billions of dollars on the stock markets last week. Well, here to unpack it all, I'm pleased to welcome Martin Fay, CEO of the Association of Superannuation Funds of Australia. Martin, great to see you. And just for the record, for anyone who doesn't know, you represent both sides, don't you?
APRA represents all the so-called APRA funds, and therefore we have both retail and so-called profit for member funds, and we love them all dearly, and they're all different and very special. Yeah,
they're having there's a lot of fighting in the playroom, isn't there?
I think what we're seeing is if you like, exposing to the public the very heterogeneous and the very dynamic nature of the superannuation sector in Australia. We have funds to meet different types of needs. We've got self-managed super, but we have a variety of other funds, and it reflects the competition in the marketplace.
Well, if you believe the Productivity Commission, you know, Karen Chester, beyond her original report, which says, look, yes, demonstrably there was fee gouging on the retail fund side, the Hayne Royal Commission has obviously picked that up. Now the Productivity Commission is actually saying beyond that, it turns out that the retail funds aren't as good investment pickers as the industry funds, and by about 190 basis points in terms of an underperformance gap. Do you think that's right?
I think the first thing to recognise is the Productivity Commission's confirmed that by and large Australian superannuation is working and is generating returns. There's no doubt they've highlighted that we do have some habitually underperforming funds and that fees do impact returns.
But didn't they actually compare retail funds with industry funds? And if you took the Productivity Commission's release at face value, if you're in a retail fund, wouldn't you be keen to pull it out and throw it into industry super?
I think it's very important that people don't sort of see it as retail versus industry. I think what we need to do is for people to say, am I in the right fund? If you're in a fund and you think you're paying high fees and you think you're not getting the returns and it's not right for you, then you should move. What we have to recognise is that funds very often offer more than just a very generic offering. Many funds want to provide control. They want to allow people to invest in particular asset classes, certain geographies. They might want to have control over their investments.
Well, precisely, but that's why we thought there was a premium that you probably needed to pay for retail funds. Now we hear that maybe it's not worth paying that premium because they're not as good stock pickers.
I think what we're seeing is that, and the Productivity Commission has said this, is that it's difficult to make definitive statements about fund performance over a period of time, even as long as 10 years. We know, for instance, that the data that was put forward also includes the GFC, where equities and international equities in particular took quite a hammering. So I think we have to be careful. You know, superannuation is a 45-year investment for most people. We need to be careful not to jump in and draw conclusions. There's no doubt, though, that high fees do erode long-term retirement outcomes.
No, fees,
and we need to make sure that we also need to recognise that risk is a factor in terms of returns are inextricably linked to the amount of risk risk that's in the portfolio.
Well, this
and diversification
is
matters.
what Chant West, the research house, was going on about, and indeed a lot of argument on the retail fund side is, well, hang on a minute, these industry funds, they've walked off and they've gone into all these illiquid assets, particularly infrastructure, which is fine at the moment when interest rates are low, but wait till those assets start becoming quite difficult in terms of delivering returns. Do you think they have a point?
I think it's important to understand how our superannuation in APRA regulated funds is allocated. So 21% in listed Australian equities, 23% in international equities. There's only about 4.5% actually in infrastructure. We've also got an allocation to cash of about 11%, a small amount to fixed income and currencies, and obviously we've got listed property, unlisted property. The notion that we as a system are somehow massively overinvested in roads and tunnels and infrastructure, I think is something we've got to be careful.
So infrastructure, you just repeat that again, that's
4.5% of the APRA regulated funds is invested in infrastructure.
And what would property be?
Property sits around 11, depending on whether it's listed or unlisted.
So it's about 15 in property and
it's about
infrastructure.
High 40s in listed equities and the rest in what you might call alternatives, which is property, listed, unlisted, cash, offshore investments.
What do you think of the argument that those on the industry super fund are sort of arguing, which is that the governance issue, that actually they've got governance right over on the industry super fund side? Bill Shorten saying that we should have independent trustee organisations on the retail fund side.
The view which ASFA very clearly has is that we shouldn't have a prohibition on particular structures in superannuation. The reality is for-profit entities play an important role. They provide a price signal, drives efficiency, innovation. A large part of what makes superannuation work is the profit motive, and let's not forget that.
So no independence on either the industry, no changes to independence on the industry fund board, but no putting the...
That's a separate issue, and it's one that's proved to be very divisive. I think what we can say about governance models is that the literature out there, in both the academic literature and the markets literature, is very confusing about both the causation and the direction of causation.
Well, your ASFA big summit, which is happening down in Adelaide very, very soon, is going to be really exciting, because I'm sure there'll be lots of discussions on this.
We're looking forward to it.
Martin Fay, it's great to talk. Thanks very much.
Thank you.
And that's all for the show tonight. Tomorrow night, my one-on-one with ANZ CEO Shane Elliott off the back of the bank's full-year results up tomorrow. Until then, see you tomorrow night at 5 p.m. on Your Money, or on Catch Up tonight at 8 p.m. on Foxtel, channel 604. Thanks for your company.